Oops. Let's get that out of the way. Okay, this is Clay Nichols. This is going to be a quick overview of SIMO, which makes flash drive controllers, or SSD controllers, if you're familiar with those. They are solid-state hard drives. They've been around for a while now, but they're really catching on and coming down in price. They're a great way to improve the performance of your computer. That's how I know about them. Although my background's in electrical engineering, so I know a little bit about the technology. So my overall plan is to watch and buy it on the way down. I've been buying some now around 65, 66 as it's going up. Don't know if it's really bottomed or not, but that's what I'm looking at. So here's my thesis. It's got high earnings per share growth next year, but then it's tapering off with a nice 3% dividend. Undervalued and high growth in the short term, but only so-so in 3 to 5 year terms. So I'm looking at a potential pop in the next 2 years. Otherwise, it's better than cash, at least, even if I hung on to it. So if it goes up dramatically and becomes overvalued, I'd consider selling it. But if it doesn't, then it still looks like a good deal. Okay, so let's take a look at earnings growth. It's very high for the next year and much lower for the next year after that, and then down for a year. Okay, so let's look for Yahoo Finance. Most of this data is from the last 4 or 5 days. Today is the 8th of April, 2022. Yahoo Finance shows that growth, sorry, it's kind of small down here, it's 14% in the next year, 7% for the per year for the next 5 years after that. And then we've got FastGraphs showing that it's up a lot. It's growing pretty fast for 2 years and then down a bit. Let's see if we can look at that a little closer. Kind of hard to see the actual amounts there, but it gives you an idea of the trend. So let's look over here at Simply Wall Street. Simply Wall Street is saying that it's going to grow 21% over the next 1 to 3 years. You can see there a rough idea of what that's looking like. WallStreetZen shows that earnings are forecast to grow. They're saying over the next, that's earnings per share. That can be affected by stock buybacks and that kind of thing. But it gives us a rough idea of what's going on. In the end, what we care about is earnings per share anyway. So this is showing 2-year forecast, 277%, which is pretty significant, pretty amazing. But all the estimates are pretty good for the next 2 years, and then varies a year after that. Revenue is kind of similar to that, up a lot the next 2 years, and then a little more divergent after that. And let's take a look at. Okay, so that gives you an idea. I'm kind of go with a more conservative 7% for the next 5 years, 14% or so for the next year. So let's come down here to. And also, interestingly, Analyst price targets. This is, I think, Simply Wall Street. They're looking at price targets. All are increasing over the next 2 years quite significantly. Simply Wall Street shows that it's undervalued, which is great. And they're looking at free cash flow, which is the value investing approach to that. And if we look at FastGraphs and assume likely worst case of 13% for the next year, and then we're going to get an ROI. If we're looking at earnings growth rate of 13%, we're looking at an ROI of a gain of about 13% as well. It is what we'd expect. If it maintains the current PE value and it grows earnings as expected, you'd expect the stock to kind of reflect that. There's also dividend in here. I'm not quite sure. Yeah, so it's a 12% earnings growth and then a 13% price appreciation, probably because it's factoring in dividend there, you can see. Okay, so that's sort of likely worst case scenario. Obviously, could it be worse than that? But likely best case scenario is if we assume that it reverts to its historic PE ratio and actually right now you can see this orange, this blue line is its historic PE ratio, and you can see the price has kind of gravitated to such a price that it maintains that PE ratio. So right now it's below that classic PE ratio. You can see down here. If it just reverts back to that and it grows as expected, about 17% for the next year, then we'd expect the ROI to be about 45% per year. So that's what I'm hoping for. And you can see the historic PE ratio here in the history graph of FastGraphs. You can see that, and this orange this blue line is what the price would be if the price changed so that the PE ratio were maintained. So you can see sometimes the price was above that value, and sometimes, as it is now, the price is below that value. So the price would have to increase for it to return to a classic PE ratio of about 14.28%. So that's what we expect. That's what the thesis behind FastGraphs is, that it's going to revert back to that classic PE ratio. The 3% dividend is well covered by the free cash flow. You can see the free cash flow diagram or chart from FastGraphs, and it is the white here is the dividend. It's below the free cash flow, so they're throwing off plenty of cash to maintain that dividend. And you can see here in this middle one, or this one up here, that it's the dividend is a small percentage. The dividend here is like 2.5 out of 6.7 cash flow. So plenty of cash flow to maintain that dividend. And also, this is what Simply Wall Street says, is that the dividends are well covered by earnings. So they're paying out 25% of their cash flow as earnings. So well covered. And just some more information. They make SSD controllers. They supply the most in the world. This is from their annual report. The SSD market, controller market, is expected to grow about 14% a year, which is pretty close to what we expect their long-term growth to be. Or actually, it's above that. My thoughts are, when we're looking at inflation, they have the ability to raise prices if raw materials go up. However, most of high-tech expenses are not raw materials, so I would not expect them to be as affected by inflation as other industries like oil or wheat or something like that, more commodities. So it's down 7.2% in the last month. And Zacks computer sector is shown to be down 17% in the last 6 months. So one place I read said, tech in general, or computer and technology, is kind of down. And that would be consistent with that. Zacks is showing that. The S&P is down 4.7% in the last 7 months, but up 13% over the last year. It's currently trading at a much lower PE ratio than its historic. And we can look here, kind of a summary evaluation. So currently it's at a PE ratio of 8.6, whereas the S&P 500 is a ratio of 20. And the price to sales is much lower than the S&P 500. So basically, it looks like it's better valued in terms of PE than the S&P 500. Some risks. If it behaves as expected, performs as expected, but the market doesn't respond. It's based in Taiwan, so there's political risk from China. However, it looks like the Ukraine is fending off China. So basically, China feels like it owns Taiwan. So, and it is announced that it would like to reacquire Taiwan, let's say. But because and this is from the New York Times last month, because the invasion's done poorly, Chinese officials are more likely to be more cautious. So I think that this fear, which was greater a month ago as Russia was starting the invasion, is probably less significant now. So just more interesting information on how the war is going in Russian invasion of Taiwan. And if I didn't mention before, this company is based in China. Let's see. So some risks from Zacks. Semiconductors highly competitive. I agree with that, but this is a very non-commodity, and SSD market is growing. I would suspect, I haven't looked at this, faster than the market in general, because what's happening is SSDs are displacing conventional hard drives because they use less power, they're quieter, and they're much faster. In my own experience, when I built my last computer, which is or spec'd out my last computer about 7 years ago, I definitely wanted an SSD drive. That improved the performance of my computer more than anything else. It's typically the bottleneck for most things like moderate end processing, like video editing, things like that. I'm not so sure about like 3D, virtual reality, stuff like that, whether it is the same constraint. At that point, maybe the processor is becoming more important or equally important. And there's macroeconomic risks as well. So that's my analysis of SIMO. Let's go look really quickly at the stock itself. Let's see. I prefer Market Watch for this. Okay, just more familiar with the. So let's go to advanced charting, and we'll look at like the last year. So you can see it was generally trending up, and then in the last, since the end of the year. Actually, it's just, it's been just since, the start of the year, it's been trending down. And you can see here the trend line, it's still trending down. I think maybe it's bottomed. So I started buying some. I'm looking to buy it at under 70. And I've bought some there, and then I'll probably wait and see if it goes down more. And if it does, I'll buy more. If it starts going up, then I'll be glad I bought it before it was obviously rising. So anyway, that's my analysis. Love to hear your feedback. Anything that I've missed. I'm looking to be smart, not looking to be correct, not smart here. Thanks.